Good morning, everyone. Sorry for a little bit of a late delay here to get started this morning. I do want to welcome you to this Monday, October 12th, 2020 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. I can tell you we got some pretty strong futures this morning, especially on the NASDAQ, where it looks like technology is going to get a pretty big lift. I know Apple seeing a little bit of action this morning. Twilio, $3 billion acquisition there. Twitter being upgraded. So it looks like we're going to get some decent action to start the week. I've been very, very bullish. I continue to be very bullish. We had some great action last week, including the breakout of transports. And I can only tell you, based on history, and especially recent history going back the last, I don't know, maybe 10, 12 years, when we consolidate on transports, the S&P 500 tends to consolidate as well. It doesn't do as well. But when we get the breakout on transports, that can be very, very bullish for the market. And I think that's, we saw the breakout in the transports last week. I think that's going to result in some pretty good action, but we'll see. Let me get into some stuff here this morning. First thing I want to do, as I always do, is invite those of you who are new to earningsbeats.com to check out our homepage. And first of all, we do have a couple of big events, maybe none bigger recently than the one coming up tonight. 4:30 this afternoon, excuse me, I'm going to be unveiling our brand new model ETF portfolio. I actually announced the ETFs that are going to be in the portfolio next week, but this will be a sneak preview. So for those of you who might be interested in finding out a little bit more about it, it is a free event. We will have the room link on this homepage later today. So you certainly could come in at that point. Anybody, though, that comes in for any of our free webinars, I just want to point out that if you do come in directly and you're not already a part of our community, either a paid member or a free member of our Earnings Beats Digest newsletter, then we'll add you to our free newsletter. There's no credit card required. You can unsubscribe at any time. We just like to keep in touch with those of you who are interested in being a part of our community. So check back in here later today and we'll make sure we have a room link up here so that you can come in. But again, this is a free event today. Tomorrow we've got Max Payne. Some of our members really love this. This is where we take a look at options. Every third Friday of the month, options expire. The traditional monthly options expire. And so we always take a look about 3 days in advance, in this case, Tuesday after the closing bell, to see which stocks might be heavily influenced by, an over or an imbalance, I guess is the best way to put it, between calls that are being traded on a particular stock and puts being traded, where there's heavy call interest. In other words, a lot of traders are out there holding calls. Many times it behooves market makers to bring those prices down. So it's, and the flip side, for those maybe that have been getting hit hard to the downside, you might get a nice little recovery. I know one group, and I'm going to go through this in just a minute, but one group that's been getting hit hard recently has been the gambling stocks. And I don't know, I haven't gone through and calculated Max Payne, but there could be a number of stocks within that area, maybe that have been hit pretty hard with puts, have been traded, investors have been trading puts. And as a result, it might behoove market makers to see gambling stocks have a strong end of the week or maybe a strong beginning of next week. So anyway, Max Payne is a separate webinar that we do for our members once a month. That is for our members only, so paid members. So if you go tonight, you like what you hear, and you think you want to try us out, there is a 30-day trial. It only costs $7, and we refund it to you within 7 days. So it's really just to get you set up in the system. Effectively, we have a free 30-day trial, and you can start that by hitting the Join Today button. But if you just want to be part of the Earnings Beats Digest, the free newsletter, type in your name, email address here, hit the subscribe button. We'll make sure we get that free newsletter out to you. It's published Mondays, Wednesdays, and Fridays. And actually this morning, I wrote about one of the ETFs. First time since we've been writing, or since this newsletter has been published, that I've talked about an ETF. Maybe I talked about the spider once before, but it was in context of the overall market. But this is actually a specific ETF that I talked about, unveiling a little bit about how we're going to be looking at these ETFs. And you're going to hear this a lot about ETFs, but it's really important to know what you own when you look at ETFs. Don't just, look at the name and say, wow, it's a cool name, cloud computing. That means, these stocks have got to go higher. Cloud computing, growing area of the market. Well, you might want to take a look and see inside the ETF and see what really is going to make it tick, because an ETF is not something that just, it's not a stock. It's a basket of stocks. So it's really important to know which stocks are in that basket and then be able to evaluate those stocks. Are you owning, there are a lot of cloud stocks out there. Do you own some of them that are outperforming the market? I think that's really critical. So we'll be taking a look at that a little bit in tonight's ETF webinar as well. So anyway, I hope you can join. I know I spent a little time on this, but I think this is a really big event. This is a little bit of a game-changing event for us, earningsbeats.com, as a business, because I know there's a lot of you that would much rather trade ETFs. Many of you maybe don't even think about trading individual stocks, and that's really been our focus throughout the years, has been on individual stocks. But we're moving on into the ETF world as well. I think you'll really enjoy this webinar tonight, so check that out if you can. Also, if you can't be there but you want to hear about it, if you're on our Earnings Beats Digest, if you're anywhere in our community, we'll send out recordings so that you'll be able to go back and listen at your leisure. You don't have to be there this evening for the event. So that's another bonus feature that we offer those in our community. All right, let's go ahead and move on. So taking a look at what happened on Friday, and like I said, I'm really bullish. I really like what's going on here in the market. On Friday, we saw the Dow Jones Industrial Average up a little more than 0.5%. The Dow, which has an all-time high over 29,000, has now risen back up to 28,586. Not that far away from breaking out to an all-time high, which would join the S&P 500, which, even though we did top out closer to 3,600 back in September, we cleared the February high. And so when I'm talking about the Dow moving to all-time highs, it's not just this high here in September. There was a high back in February that we've yet to clear. The S&P 500 has cleared that. We set a new high in September, and now we're moving back up. I think it's just a matter of time before we clear that high. The NASDAQ, on a relative basis, has been our leader in 2020. We're starting to see a little bit more movement back toward the NASDAQ. I know the futures today are heavily skewed toward NASDAQ shares. So at least at the open, it appears we're going to see money rotating back into those NASDAQ stocks. The NASDAQ up almost 1.4% on Friday. So on a relative basis, that index did much better than the S&P and the Dow. Mid caps and small caps both up, but once again, on a relative basis, they took a backseat to the NASDAQ. But I'm really bullish these two groups. I do like the fact that on a relative basis, the past few weeks, this has been a really, really strong area of the market. And we did break out above the August-September highs. Small caps right up against that August high. But the last 3-4 weeks have been very strong in these two areas. And I think that bodes well. Small caps, mid caps were hit very hard by the pandemic. And it's nice to see these areas of the market rebounding. Technology, consumer discretionary, I think these are the two best areas in the market. I believe communication services is likely to kind of throw its hat in the ring as we get later into the fourth quarter. But I think these three groups, technology, discretionary, communication services, are three groups that will continue to lead. I'm wondering about industrials. They've been performing better with transports breaking out. I think it's very possible that industrials have a very strong fourth quarter as well. And financials, I'll just be watching the 10-year Treasury yield. That's going to be key there. But you can see on Friday, technology up 1.5%, discretionary over 1%. The laggard, yawn, been the same laggard for many, many months. Actually, we go back 9 years if you'd like. The XLE has been underperforming the S&P 500 by a fairly wide margin now for 9 years. The entire time the dollar was in an uptrend, and even with the dollar weakening, energy just can't get a bid. And I think a lot of it has to do with an oversupply. Demand has started to pick back up again. I just think there's an oversupply of energy. I think there's a move toward renewable energy. We're seeing that, as you can see on this chart right here. I don't know that this has been kind of odd, but it's almost like that movie Groundhog Day, where Bill Murray, sorry, not Murphy, Bill Murray gets up every morning, and it's just like the morning before. He goes through the same routine, sees the same thing happening in the morning, gets the same coffee, the same, server, and so forth. Well, I feel like I'm getting up and I do this, I always like to do this candle glance, and I keep seeing renewable energy and gambling stocks. Renewable energy strong, gambling stocks weak, because this is maybe the third or fourth time in the last 5 days that these two groups, renewable energy has been the leader, gambling stocks have been the laggard out of 104 industry groups. I don't know if I've ever seen that before. But anyway, a lot of money pouring into the renewable energy space. You can see over these last 4 weeks, this is a group that has really come on strong. We were at 130. We closed at 177 on Friday. I mean, maybe we're even into the 120s. So, we're about probably up 40% maybe in the last three and a half, 4 weeks. On the other hand, you can see since the beginning of September, we've gone from about 760 or 770 on gambling stocks down to 650. And this is taking place while the overall market has actually been pretty strong. So for whatever reason, money's rotating out of gambling stocks. I think that's pretty important to point out. All right. Let's take a look at the 10-year Treasury yield. By the way, there's really nothing in terms of economic reports coming out today. And you can see that the strength in the 10-year Treasury yield has taken us to a level that we have not seen since that early June push to the upside. We hit 0.8% last week, and we had not hit that level since this push back in the second week of June. So important, because if you also study history, or if you follow me, you know that when money starts rotating out of treasuries, the yield goes higher. There's always an inverse relationship, 100% inverse relationship. When the yield is going up, it means treasury prices are going down. Always inverse. That's just the way it works. So when you see this move up in yields, it means money's coming out of treasuries. Well, what do you think everyone's doing with those proceeds? They're not going into treasuries. We know they're coming out of treasuries. So the proceeds are finding their way in the stock market. And there is a long-term history when the yield goes up. Now, in a bear market, a secular bear market, sometimes that money goes out of bonds and just goes to cash. But outside of a secular bear market, when money comes out of the bond market, it goes into stocks. So some of the biggest moves in the stock market occur when the yield is rising, because not only are you getting new money coming into the stock market, but you're also getting rotation. And I'm talking about billions of dollars of rotation from the treasury market, bond market, over into the stock market. And that usually helps to fuel major rises. So you can see since the end of September, this yield's been breaking out. And if we go and we take a look at the S&P 500, you will see that we're rising. I mean, we go up, and we normally go up rather quickly when the yield's rising. So if this yield keeps moving up, number one, expect stocks to go up. Number two, there are certain groups in the market that should do much better. One being banks. Many areas of the financials that have been lagging, the banks, the investment services, asset managers, those are areas that typically do very, very well when the 10-year Treasury yield is on the rise. So another group to be looking at is the banks. And you can see since the end of September, this is a group that was not doing very well, but it has come to life as the yield has been rising. So keep this in mind. Do I like banks overall? I mean, I think they're going to go higher. Do I think they're going to lead? That's where I maybe have a little bit of a problem. I'm not so sure they're going to be leaders. I think if the 10-year Treasury yield soars, then I think banks could be leaders, probably will be leaders. But I don't know that the yield's going to soar. I think we're going to go higher. But the Fed's telling us they're not raising rates. They're remaining very dovish. So I just don't know how long we're going to see an exodus out of Treasuries. I think that's going to really impact the whole banking group. All right, I want you to bear with me for 1 second because I want to talk a little bit about this ETF service. And I actually have to bring up another screen for you on this. So hopefully you can see this. This is a chart of one of the ETFs that's currently on our strong ETF chart list. So one of the things that we're going to be offering in our service, you're probably very well aware, especially if you're a member of Earnings Beats, even if you're not an Earnings Beats member, if you've been in our community or you've read my blogs, you've probably heard about our strong earnings chart list, which I think is kind of like the flagship product for our individual stock service. Well, we're going to have a strong ETF chart list that is going to kind of be the flagship for our ETF service. And so we've already created the chart list. We may be tweaking it a little bit. And this service, by the way, we're not charging separately for it until January 1st. So anybody that comes in and tries our service, our regular service now, also, as long as you're, a member of our paid service, you're going to get this ETF service for free in addition to everything else we offer through year end. So that's kind of an important deal. You can really check this out for more than, next 2.5 months, a little more than 2.5 months, and see if you like the service. But a couple of things that I look at on here, and I'm going to change a couple of things here because this is how we originally set it up. But I actually like, instead of the RSI, one feature that we're going to be looking at is a scooter. And so I'm going to bring that. I'm going to put that on this chart. And I'm going to put it at the very top. And let me update this. So a few things. When you look at this particular ETF, there's a couple things that stand out. First of all, we want to know the scooter. And this is going back for the last 3 years. So I'm thinking we'll probably have 3 years, probably a daily, maybe weekly. I'm not quite sure how the whole layout's gonna be. Maybe we'll get some feedback from our members over the next couple months and see what everyone prefers. But here's First Trust Cloud Computing ETF. So I was talking about cloud computing ETF earlier, an example. And so this is it. So you've got top 10 holdings. So knowing what you own, I think, is really important. Don't just, don't look at the title and say, wow, cloud computing has done really well recently, so that means I should just buy the ETF. Well, maybe. There's also a factor of how much you should buy. If the ETF has 5 of its top 10 holdings that maybe make up 75% of the ETF, and you decide to put 50% of your money into an ETF because it's quote unquote widely diversified, you better make sure it's widely diversified. Because if you've got Amazon, which here is only 4% of the holdings, but let's say Amazon's 22%, and you're thinking, okay, I'm going to put half my portfolio into this well-diversified cloud computing ETF. If you don't know the holdings and Amazon's over 20%, all of a sudden 50% of 20% is 10%. So all of a sudden your portfolio, you're trying to diversify, not to put too much in any one area. All of a sudden you've got 10% in Amazon. And what if you have other ETFs and they own Amazon? You're really getting, tied into Amazon. So that's just something to think about when you put together a portfolio of ETFs, is understanding what they own. You got to know what you own in terms of the ETFs, and you need to know what they own in terms of the stocks. The other thing is an ETF doesn't trade like a stock. Now, I can come on here, and I'm going to annotate this, and I can draw a price support area. Well, I mean, that kind of is important. Well, here, I'm going to first see this top right here. Notice we went up, we broke out back in August and then quickly came right back down. The support level didn't hold. I mean, we had a top there and we went through it. You know, broken resistance becomes support. That's TA 101. It didn't work. We went right down. Notice also the 20-day EMA, we held a couple of times, but notice here we went below the 20 and then right back up. Went below the 20, right back up. Here we come down, went all the way to the 50, back up, and then below the 20 and below the 50. You know, when I look at breakout here, see this top? We break out. We went well below that support area. My point here is that market makers aren't trading SKYY like they would be Amazon. You know, they're trading, they're technical traders. They see support areas. The problem here with an ETF is it's dependent on what the stocks inside the ETF are doing. So it's not going to trade and bounce off of support and resistance the same way that a that an individual stock's going to. On an individual stock, market makers are well aware of what the support levels are and resistance levels and moving averages and so forth. They're the best technical traders on the planet because not only do they have, great knowledge of technicals, they also have a great knowledge of order flow. They see the order flow before we do. They know what's out there in terms of buys and sells. So it's very important that you know individually what's going on because it's not necessarily going to show up on a ETF chart the same way. Now, I still think that there are some things that are important. Probably one of the biggest things that's important for an ETF, in my opinion, is its scooter, because you're ranking these ETFs relative to other ETFs. Now, you do have to understand there's limitations on scooters, which is the stock chart's technical rank. And that limitation or those limitations are essentially the fact that the scooter only goes back over the last 5 to 6 months. So when you're ranking an ETF, you could have an ETF that's been in a downtrend for a very, very long time, and it's getting a bounce now, and it's starting to show strong scooter score. And an example would be something related maybe to materials, basic materials, because for the longest time, materials underperformed the S&P 500, and over the last 5-6 months, we've started to see materials doing better. So it's quite possible that you're going to see basic materials ETFs showing really strong scooter scores, even though when you look at a long-term price chart, you might actually see a downtrend with just the last 5 or 6 months showing relative strength. Now, down here on the bottom, in addition to scooter scores, I want to know how these ETFs perform versus the S&P 500. This is basic, because if you've got an ETF that historically has been underperforming the S&P 500, it's not really a whole lot different than an individual stock. I mean, if the ETF can't outperform the S&P 500 and you're trying to put together a basket of ETFs to outperform that benchmark, it's going to be difficult if you're getting an ETF that hasn't shown the tendency to do that. So this is going to be another major consideration. So we've got the chart down here, which this is a line chart of the SKYY, which is similar to this. This is just a candlestick chart. But the whole setup on the charts is probably going to change a little bit. I'm going to give some more thought to that. We will certainly have by next week a strong ETF chart list that our members can download into their account at Stock Charts if they are extra or pro member. Basic member, there's limitations as to how many chart lists you can download. I think you can only download one, which you receive as a default, so you can't go in and download any of our others. Now, the maybe a little bit better news if you're not a Stock Charts member with this ETF service is that it's unlikely that we will have a lot of ETFs on our chart list. I'm thinking I'd like to restrict it to about 25 to 50. I can tell you leveraged ETFs will not be a part of our service. So if you're thinking that the 3x small cap, that that is not going to be. To me, they just get very skewed. They're very risky. We're not going to suggest that for our members. If if you like, if one of the areas of the market or one of the ETFs on our strong earnings chart list is the IWM, which tracks the Russell 2000. So that's small caps. If that happens to be on our list and you like the chart and so forth, and you decide, hey, I'm going to get 3x the Russell 2000 bullish, feel free. That's up to each individual. But we're really going to try to be a little bit more cautious in that, because we know a lot of our members are not going to be interested in that kind of risk. So it's certainly available to our members to do it. I just am not going to promote the leveraged ETFs or the inverse ETFs. If I'm bullish the market and the market pulls back and has a 10% correction, or worse yet, we saw the cyclical bear market, the fourth quarter of 2018 with the trade war. We saw another cyclical bear market this year with the pandemic. When that happens, those inverse ETFs are going to start to look really good. But I believe we're in a long-term secular bull market. I have no interest in an inverse ETF. So it's kind of like shorting in our individual stock service. We don't have really a short chart list because we don't think it's prudent to be shorting this market. We think the market's going higher. Why would we short it? If 80% of the stocks are going up, the odds of picking a correct stock on the long side is a lot easier than picking a correct stock on the short side. The odds are just better. The probabilities are much greater. So that's the whole idea again with the service is, even though it's ETF based, it's still overall market guidance that's going to influence what we do in the service. So in addition to the top holdings that you can see here, there's also the sector weighting. Now I've seen some stocks or some ETFs have maybe technology in their name, and then you open up and you see sector weighting, and industrials are the largest, sector in terms of sector weighting. And so the name is a little bit misleading. So you want to make sure you understand your sector weights. The other thing too is, if you put together 5 or 7 ETFs in a portfolio, you want to make sure that they all don't have 80% technology. That's not going to be, and I'm somebody who really is not a fan of diversification, but technology is not the only area that's doing well. So I don't want to, it's like, okay, software, I love software, but I'm not going to go out and buy 10 software stocks and put it in our portfolio. Just because I like software, I'm not going to be that dumb, because I think that's dumb. Yeah, software, there's some great companies out there, but if they have a sudden hit, what if Microsoft comes out and issues a warning? What do you think that's going to do to the software group? You don't want to have that kind of risk in one industry group. So part of our service is also, when we put together this ETF model portfolio, we want to take a look at sector weighting to make sure when we put together, whether it's 3 ETFs or 8 ETFs, and I have no idea how many there'll be in our model portfolio, but when we put them together, we want to look at the true weighting of the entire portfolio and make sure we're comfortable with that. So it's not just stocks, it's also sector weighting. So I thought what I would do as a final closeout here, there are really no earnings reports, by the way. That's why I'm not really doing our standard show today. But I thought I would take and look at these 3 top holdings here: Amazon, Microsoft, and Alibaba, and use those as our 3 you must see to wrap up the show. So let me get out of here. And I really do want to encourage you, if you're a fan, if you're an ETF, even if you're not an ETF fan, trust me, this webinar this afternoon will talk a lot about our portfolios, our individual stock portfolios, because we're really going to try to model, no pun intended, but we're going to model the model ETF portfolio after our regular model portfolio. Our favorite ETFs trying to outperform the S&P 500. And it's going to be tougher in an ETF. And I'll talk about that a little bit later in the webinar. Let me go ahead and I'll save that. All right, so let's take a look at the three stocks I just mentioned, and we'll get in, wrap this thing up. Stock market is open now, by the way. It is 9:30 Eastern. So you can see Amazon already up 55 today. Futures were strong. I expected many of these technology stocks to get off to a great start. I see an uptrend here on Amazon, and I think we've got a cup. Now, could we have an inverse head and shoulders? Very possible. Left shoulder, move back up in here, put in a neckline, ahead. Today, we could be, if we pull back over the next few days, couple days, get back to 3,200 on Amazon, or maybe even slightly below, that could put in an inverse right shoulder. So that's a possibility. Now, sometimes when I say this, I get misinterpreted and people think, oh, he's saying to sell it. I love Amazon. If, I wouldn't be a seller. This could just be a cup. We may go straight up 36, 35, 3,600. What I'm saying is that I wouldn't be rushing to the exits and being, panicked out of Amazon if we pull back 150 points. I think that could be setting up, and even 250. I mean, that would be back to 3,100, but that would be right at that left shoulder. We could put in a perfectly symmetrical inverse head and shoulder pattern. So I'm just saying I like Amazon. Pullback here would not be the worst thing in the world. PPO starting to strengthen. We've got the volume trends I think are still strong overall, longer term. So I think the stock looks pretty good here. Next up, Microsoft. Microsoft also gapping up today, up 1.5%. This one, call it inverse head and shoulder if you want. If you call it that, we broke out on Friday on this move, going through the neckline around 215. They got another gap up today. If you call it a cup, well, we could pull back, watch that 20-day moving average. But long-term uptrend, I look for continuation patterns. Those are the two patterns I see right now. Possibility of a cup, possibility of a breakout already of an inverse head and shoulder pattern. Last one, Alibaba. There's another great looking chart. This one actually broke out above the September high. So on a relative basis, this is going to be a pretty good leader, I would say. I'm going to pull up a relative chart here. Relative to the broadline retail, this has been in a downtrend for months. Sideways consolidated. Now it's starting to trend higher versus broadline retail. As long as this uptrend continues in this relative strength, and we're seeing solid volume trends, and we're seeing the stock trade above the 20-day moving average, I really like Alibaba. I think this is a strong looking chart. Okay, that is it. Let's get a quick update on the market. And you'll see right now the Dow up 80, NASDAQ 20, or excuse me, S&P 23, almost 24, over 3,500 though. NASDAQ up 148 points. So we are seeing some renewed strength in NASDAQ names, which is a good sign. Apple up nicely today. You can see leading the Dow Jones, Microsoft, Salesforce.com, Intel. We're really looking at the technology group helping to lead the market to the upside. All right, that's it. Again, later today, 4:30 Eastern. If you can join us, we'd love to have you for this ETF, in our initial really ETF foray, if you will. And we're really excited about it. Love to have you come in. If you'd like to look at individual stocks, I'm sure there'll be plenty there for you. And if you can't make it this afternoon, make sure you subscribe to our Earnings Beats Digest newsletter. If you came in late today, I'll just point this out over here on the website. Just go into earningsbeats.com and right here, subscribe to our free newsletter, because we will be sending out a recording to everyone in our community. So if you're signed up to our newsletter, you'll be sure to get that. Everybody have a great day. Look forward to seeing everyone later this afternoon. Happy trading.